Weaker than expected jobs data. It's taking a toll on the indices. On Wall Street, job growth has slowed more than expected. It's come in at 1.14 lakh jobs for the month of July. And unemployment rates are at the highest since October 2021 at 4.3%. It's certainly pulling down stocks. Stocks like Bank of America down, Caterpillar trending down. On the other hand, you've seen Treasury Yield sink around 3.8%, which means they're at their lowest levels since December. So these mixed macroeconomic indicators make it tougher now to gauge what the Fed's move is going to be come September. In the stock markets, indices coming off a losing session. Nasdaq has declined 2%. All of this in the back of the kind of earnings we're seeing from some of the tech majors. Amazon missing revenue and guidance estimates. Intel falling on the back of weak guidance for the fourth quarter. There are layoffs in the company. The spillover has impacted Nvidia. And right now, I'm seeing that pressure build up. The Nasdaq is taking a knock of more than 2.5 percentage points. The Dow Jones is down about 2.5% as we speak. And the S&P is also down around that much, 2.5% kind of gash. So it is a sea of red right now as far as the indices on Wall Street go. Oil is trending down. So is gold. We will understand what's at play over here. Is it about the macro concerns? Is it about a sell-off on tech stocks because of some kind of profit booking? Santosh Rao is joining us, Head of Research and Partner at Manhattan Venture Partners. Santosh, it's always a pleasure having you on the show. Do tell us, this weak guidance and layoffs coming through from Intel, it has sparked off concerns in tech stocks. But is this pain a blip? Because there is also a sense that this tech sell-off that we are seeing today is largely because of profit booking. What's your reading?
Yes, thanks for having me. Well, the combination of reasons, and they've just come all together, a perfect storm, so to speak. We knew things were slowing down. The consumer is slowing down. The demand is slowing down. So that we knew that. So I think that's coming together. The corporate profits are down. CapEx is up. The company's spending a lot on AI chips and all that. So profitability is down, not necessarily for a bad reason. They're just spending for the future. So I think it's showing up in the bottom line. So you saw that the effect of that in some other companies. So net, I would say this was long expected. We knew things would slow down. The only issue was, do the rates need to come down to reflect this thing? So now the debate is not about cutting rates 25 basis points, is about, do we do more than that? Do we go to 50 basis points, or do we just do 25 and then do 25 in the next two as well? So a total of 75 basis points this year. So that's the debate right now. So let's wait and see. The knee-jerk reaction is of course bad. It spooked the market. We did not want to. We kind of knew that this was brewing underneath. The unemployment claims had gone up, and unemployment rate went up. So all those things, signs of things slowing down, and we saw the effect of all that. So let's wait and see. The knee-jerk reaction is, of course, understandably bad, but let the dust settle, and then let's see what exactly is going on.
This kind of fear about an American recession right now, just going by the unemployment data, you said this was brewing, but is there a growing sense the Fed has held off too long to cut interest rates? And that is what is spooking the markets right now. That is it too late, going by the macro numbers?
Well, that's the age-old debate.
Yes.
They didn't know anything. They were behind the curve coming into this raising cycle. And are they late in the cutting cycle? That's the debate that's going on. It's a tough job. And now we're heading into the election year. Can they really cut in September and get in the political crosshairs? So that's another issue. But I think they go with the data. And he said that in the last meeting that he's apolitical. He doesn't look at the political wins. He's doing what's right for them. So anyway, that's that aside. I think that he could have cut this time. But then that would have caused panic. After telegraphing that he's not going to do it, suddenly if you start cutting, then there's a sense of panic that maybe things are very bad. Things are very bad right now. So he has to do more. And that's what happened, really. So now the odds of the Fed cutting in September are like more than 80% at this point, and is definitely going to cut. He said that, but more than 25 basis points, 50 basis points, the odds of 50 basis points have gone up. So if he does that, then definitely that's a final stamp that things have slowed down, conditions are restrictive enough, which is what he wanted. But he wants a smooth landing, and that's what we were expecting, a soft landing. We're still hoping for that. We don't want too many cuts, too much panic in the market. Let's wait and see if what's really causing this thing. Is it just a normal economic cycle, or is it something really deep? We don't know yet. The geopolitical tensions don't help. That can cause the energy prices have spiked up. So that's putting more fuel in the fire, so to speak. So all those things are adding
So
up.
putting
It's a
panic,
perfect storm of events going on.
you did mention that there
Oh,
could be a faster pace of cutting these borrowing costs coming through by the Fed to avoid a hard landing. Do you think that is possible? Because you're talking about the rate cuts, the expectations in September, or perhaps, I don't know, as far as how quickly they need to cut rates right now, that would be weighing on the Fed's mind.
absolutely, absolutely. They're watching this thing very closely, and I think it's a pretty given thing that he'll probably. I mean, he's already said it that he's cutting rates. So we'll just wait and see. Is it going to be 25? Is it going to be 50? Or is it even going to be one full point? So he's going to be totally driven by the economy. We're going into the election year, like I said, election time. So a lot of delicate balancing going on at this point, I'm sure. So let's wait and see some more data. There are two more CPI reports before the next cut meeting. So let's hope that that's kind of moderating, not falling off the cliff. So the last thing we want is recession or stagflation.
Yes.
No growth, still high inflation. So that's the worst thing that can happen. So let's hope and let's pray. The data seems to suggest that things are moderating gradually, which is what he wants. So this is a
Where
knee-jerk
do you think
reaction.
interest rates will
It
settle
came
eventually,
along with
Santosh?
what's that?
By when do you think we'll see the interest rates settle and at what levels?
Well, I think he's going to cut at least, I would say, 100 basis points. So we're going to come down to this year, at best, at worst, rather, you can say, is three cuts, one in September, one in November, and one in December. But if things get very bad, unemployment, you start hearing all these stories and layoffs and claims. So he might do 50, 50, 50. So 150, that's the worst case scenario. So, I mean, he raised 525 basis points. It was zero literally. He went up to 5.25. So he has a lot of room to cut. So it can very well be up to 150, kind of bring it down appreciably. So he kind of keep the economy going and not just slam the brakes on the whole industry. So whole economy rather. So I think there's a delicate balance. We'll have to wait and see. Next few weeks are going to be important. All the earnings reports are coming out. They're generally on the softer side. But we'll wait and see. I think a lot of data to go through and see what exactly is going on. So I think that's the thing. I'll
So,
stop there. I think
yes.
generally rates are going to come down. How far and how fast? That's the big issue. And I think it's just going to be gradual.
But meanwhile, what happens in India for one? Because any kind of weakening in the American economy is going to definitely have an impact. Even a perception of weakness, any kind of hard landing, it's going to affect Indian markets, especially our IT companies and their stocks. How do you see that play out?
Absolutely. It's going to have a spillover effect. It's going to have a domino effect all around. A lot of places are slowing down. I think Japan raised its rates. That has its own dynamics there. The Middle East is something going on there. So it's definitely going to have an impact. But let's say India is it's a very consumer-driven economy. So as long as they can maintain their inflation under control, keep the demand picture pretty stable, I think they'll be okay. They're not totally dependent. They're not dollar denominated totally like some of the other countries are in terms of their debt and other areas. So India can be less affected other than other places where they're so dependent on the US one to one, literally. So it's a mixed bag at this point. But there is definitely going to be an impact, a moderating impact around the world. If US weakens, we need US to drive the engine, and if US weakens, the whole engine collapses. So at this point, I think it's too early to say if anything is too bad. Things were expected to slow down, and they are slowing down. So I think let's hope that every country has moderated their economic policy based on what is expected, what was expected.
You're right about the domestic factors playing the lead role when it comes to the RBI's decision, something that we've seen happen consistently in recent times. But there will be cues, and we'll have to consider where the American economy heads from this point onwards, something that we are keenly watching. Even the markets right now, you're seeing those gashes coming through. They are not deepening as much, but yes, they're still in place. We'll continue watching, and thank you, Santosh Rao, for joining us with your perspective on what's happening right now.